we're looking at the numerous ways in which market indices or indexes are actually used. And I mean, many of them are quite obvious. Nevertheless, a few are, I think, quite interesting to point out. First of all, they're used as a gauge of market sentiment, basically what the market is feeling, the atmosphere in the market. And this is very much the original reason for why indices or indexes were, market indexes were created, to give a reading of the mood or reading of the atmosphere, the confidence with which investors approach and view the market. Second, and this one is I think quite important, they're used as proxies for measuring and modeling returns, and very much for systematic risk. Okay, and also risk-adjusted performance plus risk-adjusted performance. Good. So the first two lines here, measuring and modeling returns, systematic risk, this is very much to do with, they're used to, especially under something like the capital asset pricing model, which you hopefully will already know about. In the capital asset pricing model, in the CAPM, you need to estimate or forecast returns on a broad market portfolio. So an index, if it's broad indeed, can be used to indeed represent that broad market. Yeah, for example, in the capital asset pricing model or some similar model, which once again relies on the broad market. Now, for risk-adjusted performance, the book gives a really nice example of how you can use an index. Let's say, and I'm going to basically replicate this example with slightly changed numbers. Let's say you've got an actively managed fund, and let's say this fund has a beta, so a measure of systematic risk of 0.8. And of course that fund generates some returns. Okay, in order to evaluate the skills of that fund manager running that actively managed fund, what you could do is, knowing the beta of that fund, you could construct a completely passively managed portfolio, which would also have a beta of 0.8, and see how it performs relative to the actively managed fund with the same beta, to see whether the manager is really adding any extra returns. But we would have the same risk. So you're not, comparing a market portfolio which would have a beta of 1, for example, with the manager's returns on their portfolio that has a beta of 0.8. You get the betas, so you get the measures of risk adjusted to such a way that they are the same or comparable, and then you see how things play out. So how would you construct a passively managed portfolio with this level of beta? Well, you would take your money, your funds, and you'd allocate 80% of the funds, of the money, to a portfolio that's constructed in line with the index, and accordingly 20% of that money, of those funds, you would keep in cash. Well, that is something that has cash earning some risk-free rate of return that has no exposure to the market portfolio. It's supposed to just earn the risk-free rate of return. And then compare what the active manager does in terms of returns generated with the returns from this sort of synthetically created passively managed portfolio with the same level of risk as measured by beta, and measure the difference in returns achieved. That difference is what we call alpha, and it should be a measure of the active manager's skill. Obviously, if it's positive, if the active manager can deliver better returns than this passively created and managed portfolio, then measure of active manager's skill. But very importantly, we made a risk adjustment to start with. That's very critical. Or indeed, lack of skill if the difference is actually negative. Or perhaps it will give us an indication of the fact that, yeah, maybe the manager is skillful, but the transaction costs are absolutely too high and eating away the extra profit or the extra returns, or maybe the fees which the manager charges mean that after all the fees are considered, that alpha is not significant enough to be impressive, or indeed not positive at all. So lots of explanations may become apparent, but it's useful to perform this exercise. Now, another reason for indices or indexes being useful is that they are absolutely used as proxies for asset classes in asset allocation exercises, in asset allocation models. So, when you talk to an investment client and we talk about things like, let's put a certain amount of your money into bonds, into stocks, into this or that, we typically use indices to give us an idea of the historical risks and returns for the different asset classes that we kind of project into the future as well, very often. What else? They are also used as benchmarks for actively managed portfolios. And here, theoretically I said, well, let's use them as a basis for risk-adjusted performance comparisons. But when we talk about benchmarks for actively managed portfolios, you should know that active managers select benchmarks typically against which they wish to be measured and which they aim to outperform or to beat. They aim to beat or outperform a specific benchmark, typically an index, and the selected benchmark should reflect the strategy followed by the manager and should be as close to the strategy followed by the manager as possible. And the final one is, I think, is quite interesting. The previous ones here, this one and this one, are quite obvious, to be honest, but they're also used to model as model portfolios. Sorry, not to model, but as model portfolios. So kind of example portfolios for investment products. So they're absolutely vital these days in new investment product development, as you will for sure know, because we've done videos on this. Very popular these days are exchange-traded funds, ETFs, and ETFs need to have a basis which they try to replicate or follow, and that's going to typically be an index of one sort or another. Sometimes very specialized, sometimes very niche, like an index of robotics companies or companies focusing on the circular economy or something like this. Now, the truth is that new indexes or new indices are being developed, are being created by index providers to satisfy the appetite for freshly themed ETFs, to serve as the basis for new ETFs. Because let's be honest, ETFs have already been created that follow and replicate the very popular indices like the S&P 500 or other similar ones across the world. So there is an appetite for more, and this is being constantly dished out by the index providers.